Navigating the world of mutual funds can often feel like traversing a labyrinth, with various metrics vying for your attention. The myriad of return types like annual returns, trailing returns, and rolling returns often leads to confusion. Each of these metrics offers unique insights into a fund's performance, helping investors to make better informed decisions. In this video, we aim to break down these key metrics using the Parag-Parikh Flexi Cap Fund as an example, comparing its 5-year trailing returns of 24, 37%, 5-year rolling returns of 17, 4%, and annual returns of 37, 2%. By understanding these differences, you can better focus on the metrics that matter most to your investment strategy. Annual returns measure the percentage change in a fund's net asset value, NAV, from January 1st to December 31st of the same year. For instance, if the Parag-Parikh Flexi Cap Fund had a NAV of Rs 51.88 on January 1st, 2023, and it rose to Rs 70.24 by December 31st, 2023, the annual return would be an impressive 37.5%. Annual returns are easy to calculate and understand, providing a clear snapshot of performance within a specific market climate, whether bullish or bearish. However, their simplicity also means they don't account for compounding, making them less useful for long-term investors focused on multi-year growth trends. For example, the Parag-Parikh Flexi Cap Fund's 5-year trailing return as of March 5, 2024, stood at 24.37%, indicating that, on average, the fund grew by this percentage each year over the past 5 years. This metric is beneficial for long-term investors because it shows compounded growth over time. However, trailing returns don't capture the fund's volatility and interim fluctuations, which could be crucial for assessing risk. Lastly, rolling returns offer another perspective by calculating the average annual return over various overlapping periods within a given time frame. They help assess consistency and performance across different market cycles. For example, the Parag-Parikh Flexi Cap Fund's 5-year rolling return of 17.4% might suggest a steadier growth pattern when averaged over numerous subperiods. By examining 5-year periods rolled monthly, investors can get a sense of how the fund performs under varying market conditions, helping them understand both potential risks and rewards. In conclusion, understanding these different types of returns can profoundly impact your investment decisions. Annual returns are simple and useful for understanding performance during specific market periods. Trailing returns highlight long-term compounded growth, and rolling returns provide insight into consistency and robustness. When evaluating a mutual fund like the Parag-Parikh Flexi Cap Fund, it's crucial to consider all these metrics to get a comprehensive view of its performance. By doing so, you can align your investment choices with your financial goals and risk tolerance, ultimately making smarter, more informed decisions. Let's dive into these concepts further and see how they can help sharpen your investment strategy. Rolling returns provide a more comprehensive analysis by measuring a fund's performance over multiple overlapping periods. This helps assess how consistently a fund performs across different market conditions. For example, rolling returns for the Parag-Parikh Flexi Cap Fund were calculated for 1,233 overlapping 5-year periods between 2014 and 2023, with the average rolling return being 17.4%. Rolling returns give insightful information about a fund's performance during various time periods and reveal its consistency and volatility. While complex to calculate compared to annual or trailing returns, they offer a better perspective on a fund's long-term reliability and risk profile. Volatility, the degree of variation in a fund's returns over time, is crucial to consider when evaluating fund performance. A fund may showcase strong long-term returns but also be highly volatile, presenting a higher risk to investors. Unlike annual returns, which provide no insight into volatility by showing just 1 year's performance, trailing returns reflect compounded growth but do not account for fluctuations during the investment period. Rolling returns, however, capture these fluctuations, giving investors a clearer idea of the risk involved in holding the fund. Market cycles, periods of rising, bull markets, and falling, bear markets, significantly influence mutual fund returns. Some funds may excel during bull markets but face challenges during downturns. Evaluating fund returns across different market conditions is vital to understand how a fund performs over time. Annual returns might show excellent performance during a bull market, but give no clue about bear market performance. Trailing returns can mask poor performance in downturns by only showing average returns. Rolling returns, on the other hand, offer a more accurate and comprehensive view of a fund's resilience and behavior in varying market conditions. Risk-adjusted returns measure the return a fund generates in relation to the amount of risk taken, Metrics such as the Sharpe ratio or Sortino ratio help investors assess whether a fund's returns justify the risk involved. Annual and trailing returns do not consider risk, whereas rolling returns offer insights into both consistency and volatility over time, providing a better understanding of the risk-return trade-off. This makes rolling returns an invaluable tool for evaluating a fund's performance in a risk-adjusted context. In conclusion, annual returns are best for understanding a fund's short-term performance, but are limited for long-term investors. Trailing returns, showing compounded annual growth rates, CAGR, give insights into long-term growth suitable for those focused on multi-year investments, though they lack information on volatility. Rolling returns provide the most comprehensive view by demonstrating how consistent a fund's performance is across various market conditions and time periods. When selecting a mutual fund, it's crucial to consider all three types of returns, annual, trailing, and rolling, to get a complete picture of the fund's performance, volatility, and risk. Understanding various investment returns is crucial for making informed decisions. Our deep dive into annual, trailing, and rolling returns aim to equip you with the knowledge you need. Each type of return provides unique insights that can aid in selecting the most suitable mutual funds for your portfolio. Annual returns give you a snapshot of the performance of an investment over a single year. This data point can be useful for assessing the short-term success of a fund, but should not be the sole determinant. Relying only on annual returns may give you a misleading picture due to market fluctuations that may not reflect long-term performance. Trailing returns, on the other hand, measure performance over a specific period, regardless of the calendar year. Whether it's a 3-year, 5-year, or 10-year period, trailing returns can offer a broader understanding of an investment's consistency and resilience over time. These returns are handy for observing how a fund has managed market ups and downs. Rolling returns take the analysis a step further by evaluating an investment's performance over multiple overlapping periods. This method smooths out the impact of market volatility and provides a more comprehensive view of a fund's performance. By examining rolling returns, you can identify trends and patterns that might be missed with annual or trailing returns. Combining all three metrics gives you a well-rounded perspective on an investment's potential. While annual returns cater to short-term achievements, trailing returns reveal medium-term consistency, and rolling returns highlight long-term trends. Relying on just one metric could lead to skewed investment decisions, making it essential to integrate all three in your evaluation process. Investing wisely requires a multifaceted approach. Look at annual returns to gauge recent performance, trailing returns for medium-term stability, and rolling returns to understand long-term trends. No single metric offers a comprehensive picture, but together they can provide valuable insights that guide your decisions. We hope this exploration into the different types of returns has clarified how to use each metric effectively. Whether you're a novice investor or a seasoned one, understanding these returns can enhance your investment strategy. Remember, knowledge is power in the world of investing, and the more informed you are, the better choices you can make. If this video has been beneficial, please like, share, and subscribe for more insights into smart investing and personal finance. We appreciate your support and encourage you to engage with us. Drop any questions or topics you'd like us to explore further in the comments below. Your feedback helps us create content that meets your needs. Thank you for watching and joining us on this financial journey. Stay tuned for future videos where we'll continue to delve into essential investment strategies and tips. Until then, happy investing, and we look forward to seeing you in our next video.